Happy New Year! It's 2022 and we are off to the races with our team. We've had countless conversations with clients over the last several weeks about making a move in 2022, so I thought it would be a great time to interview a top lender in Northern Virginia to ask him the hard questions. We'll discuss rates, set expectations for what we predict will be another very competitive market, and where we think there's an opportunity that often gets overlooked. As always, make sure to subscribe, and if you're ready to chat over coffee or Zoom, find our link below.
Okay. All right. So, hey, I just want to say, Jerome and Joey, it's great to see you guys this morning. You guys are with First Savings. Can you just tell us a little bit about yourselves, where you guys are located, what you guys like to do? And then I got some questions I really want to pick your brain as we're going into 2022 predictions. How can we help all of our clients in this low interest rate environment, but also low inventory? And maybe we have some ideas that we can at least offer to our clients as we're going through what I think is still going to be a low inventory environment, at least for a portion of this year. So it's all yours, Jerome and Joey.
Yes, sir. Thank you. Thanks, Tim. My name is Jerome Jones. I'm with First Savings Mortgage. I've been here for going on 14 years. We're a local private company, correspondent lender. We do all funding, underwriting in-house, quick closes. We're always available. So we know the market very well. And this is my partner, Joey Joe.
Hey, guys.
I'm ready to answer any questions you have, Tim.
Great. Well, Jerome, I mean, I know you guys got a pulse on what's happening right now. What I'd like to do is educate realtors as well as consumers. We hear all the things on the news and they say, oh, the interest rates are, there's inflation, there's interest rates. We need to go ahead and push these interest rates up a little bit. And I think what we have in the consumer world is, oh my goodness, I was looking at buying a house, my interest rate's going to shoot up, or I had a credit card, my interest rate's going to shoot up. I just want to know, I mean, can you just simplify this so we understand how what we hear for the federal minutes about their meetings on interest rates, and how does that impact what you guys are doing every day on your interest rates? What's the scoop? Tell us.
It is widely expected that rates are going to increase in 2022. How much, when, that's to be determined, and very challenging to forecast. The Fed has announced that they're going to taper mortgage-backed security purchasing. That's going to increase interest rates. It's just when, a matter of time. Inflation is also going to drive higher rates as well. Our analysts here at First Savings are forecasting higher rates in 2022. However, we think it's going to be in the second half of the year. Omicron is having is a major factor in where rates are going to move the first quarter of 2022. I believe rates are going to stay level or steady for the next, I would say, 2 quarters. So the next 4 to 8 months.
Okay. So that gets us through the winter and the spring market, which kind of mesh together in Northern Virginia.
Right.
So, I mean, we've been telling our clients, and just if they're thinking, well, we're going to think about buying a house in April. And I say, great. When you're on our website on the calculator, I asked them to kick it up. I said, look, all the Zillows of the world are going to throw you this like a magical number. That's like probably under 3. I just want you to pad that a little bit. That way you're really getting a better idea of budget. What are you telling your clients that are in the market, but really have a late spring kind of timeline? What are you guys telling them?
Same. If you're going to be looking in spring or in the summer of 2022, you should pad the rate. I would say 1/4 to even 0.5%, depending on when that move-in date is expected. If you're looking to, like, customers calling today to refinance, you should do it now, because at any point the rates can start picking up, and it's the writing's on the wall. We're going to see higher rates in 2022. It's just when. Even we're saying rates are going to be higher. They're still historically low compared to the last 10 years of mortgage lending. I mean, we're at a very good time as far as interest rates and also the housing market as a whole. Values are going to continue to climb, which is great. The nation has more equity in their homes today than ever. It's an incredible time, I believe, to be in real estate or the mortgage industry.
Mm-hmm.
Yeah, and I think that also is helpful that in some ways, I think it's helpful that we have seen the loan limits going up.
Right.
For everyone. And when does that kick in? Is that January 1, or are you already building case numbers?
Already in place. Yeah, we put it in place about 2 weeks ago.
Okay, so that's for your Freddie conventional. But when do you expect the FHA VA?
The first week of January, and they'll follow suit. They'll follow the Fannie, the agency limits. They'll follow suit. FHA and both VA. So normally it's the first week of the new year when they announce and actually officially start taking those cases. We cannot register or take advantage of those loan changes with any government product until it's actually the announcement has been issued. So it'll be the first or second week of January.
Got it. That makes sense. And everyone has a different crystal ball.
Right.
But we're seeing, and I'm glad that you said like 1/4 to 1/2, because just from what we're reading, we're seeing that they expect it to be like 3.7 or somewhere at like 3.75, by the Q3, Q4. So, I mean, we can't all know that, but it's just good for us to budget that for people that are considering buying a house this year to be ready for a little bit higher interest rate.
Also, a competitive market too. Inventory is going to remain low, and if you have higher interest rates, you're going to have more competition, higher payments. So that's something certainly to consider. If you could probably move up that timeline as far as when you want to go start shopping, looking for a property, now is probably ideal.
Jerome, you're hired. Joey, that's our words every day. I can't tell you. I mean, especially in the wintertime, right? There's still competitive market. I was at a show yesterday in Oakton, which is one house under $1 million. One house, right? And it was booked every 15 minutes. And I was like, what's going to happen here? Right. And here's the other thing funny about it is that it was back on the market, or it was like, so, and they put it back on the market at a price that was higher than what they originally listed it for. And I was like, here we go. But you're right. I mean, it's leveraging this. So getting your idea of maybe if your budget is 700, well, what you think is your budget, why don't you play with that a little bit with your lender and talk about, well, what does it look like if I do on my payment every month, if I do have to bid this up to 750, 760, if I'm gonna live in this house for 5+ years, it just makes sense for me. So
yeah, when we're issuing pre-approval, we'll share an Excel file with the client, and we usually pad the rate 1/4 to 0.5%, and we explain that with the client over the phone. Depending on your price point, obviously the loan amount, it's not a huge impact in the monthly payment, but for someone that's a first-time buyer, it will change their price point. It could push them out of the market if rates go up 1/4 or 0.5%.
Yeah. Okay. We could talk about all those things, but these are all great conversations, probably on an individual level. We all know that, but that's great information generally about where we see things going in 2022. Like I said, I think we can all pretty much agree with, firstly, interest rates will go up, still historically amazing rates, but be prepared. Second, we're still in a competitive market, especially in Northern Virginia. We have people that have great jobs and they got to live somewhere, and they're still looking for the home to live in and a place for work from home environment. So there's that second one. And then the third one is probably that we know that the limit increases are going to go up. So that's going to help people leverage maybe buying more home than they may have been able to last year.
With less money down, right?
With less money down, exactly.
Yeah, right. That's what's incredible. I mean, you can purchase $1 million home with 5% down using an agency product. So I get a lot of questions. When is this bubble going to burst? And you mentioned it earlier. I don't see that happening at any point anytime soon, because it takes default in order for that to happen. And we have more equity. We have employment in Northern Virginia, Maryland, DC. We have jobs. We have income. We have stable income. And we have qualified mortgages. Like the individuals that we're lending to, these are qualified clients where we've reviewed income, we've reviewed credit, we've reviewed assets. They're putting down 5, 10, 15, 20% down. And that's not something that I'm willing to lose. So I'm going to fight to keep my property. And we didn't see that 20 years ago or 15 years ago when the market crashed, because the guidelines were regulated by Wall Street. And now we actually have qualified mortgages, which I'm excited about, because I want to continue to help clients refinance, eliminate mortgage insurance. The values increasing is a humongous help for all home buyers in refinancing and selling, purchasing. It's a great market. I'm excited for next year. I think it's going to be another great year.
Yeah, that's really good and all. It's very positive. Last point, and then I want to ask you some serious questions about what do we do with our buyers in a certain scenario. But
okay.
So what going on with that is that, last year alone, if you just look at national averages, I believe from what I can see nationally that most homeowners got about $55,000 more in their home in equity nationally.
Wow.
That's a lot. It's a lot of money, right? So that gives them the opportunity to either sell and trade up, move out of the area, or if they're in that scenario where they happen to lose, or God forbid, lose their job and they need to move, they're not having to sell like a short sale. They just sell the house, right? And take the earnings and move to their area if they need to. So it's all positive, I think, in many different seasons of life for many people.
Sure.
That's great to know. Okay, though, Jerome and Joey, I got to pick your brain. So I was talking to Gary Wu on my team the other day, phenomenal buyer's agent, just top notch. And we were brainstorming some things because, as you guys are seeing, we're in a tight market. And we are also seeing that things that are sitting on the market a little longer are usually properties that need a little TLC. They need the kitchen updated, or bathrooms, or maybe whatever it may be. There can be certain things that they just need work, but the prices are pretty high right now. So there's two parts of that: negotiating the price, but then there's also the money that's needed. And for some of our buyers that are trying to get in this market and capitalize on this interest rate, but they have to add the extra money for getting things done correctly so they can live in it. We asked you the other day if you had any scenarios or options for these type of buyers to be able to maybe roll it into a loan. I don't know. So I'm just going to ask you, what can we do?
I think I would start with like a higher LTV financing. Like, so if you go into to purchasing a property, mentally, a lot of home buyers budget is 20% or maybe 10% down. I think you look at first, what I would recommend is looking at financing more. If you can finance more at acquisition, that frees up some of your liquidity to make these improvements. Or you can also look at borrowing money from a TSP or retirement for the down payment, then again, use your own personal assets for the improvements. Getting into renovation or construction financing, they're mostly not fixed rate mortgages. We do offer them. We offer programs where we can do ground up construction or just an addition or maybe even just cosmetic improvements. We have programs for those options. However, they're usually short-term programs, so they need to be refinanced at some point. The secondary market really has, like, we're a mortgage lender like any bank or credit union. We have investors in the construction financing, renovation financing. Because of the draw schedule paid to the contractors, there's not a high demand on the secondary market. So we know that. And so we will hold and we'll fund the draws internally at First Savings. But after the project's complete, if you're looking for a big project, we do have to refinance that mortgage. Okay. You know, if it's just cosmetic, I would look at the lower down payment options. And if let's say that a buyer buys with 5% down, and that 5%, the funds that they use for the down payment, if that's enough to cover the improvements they're looking for, paint, carpet, maybe kitchen remodel, we have an option where we can do a home equity line up to 100% as well too. So if you invest 5%, 10%, immediately after closing, we can work on a home equity solution that allow you to get back that 10%. The file that we use for the purchase acquisition is the same file that we're going to use for the home equity. So we'll use the appraisal, which is important. So the costs are minimal, like to do that. And the limit with that is 250. The loan amount limit is 250,000. So that's super popular as well because you're essentially tapping into the equity that your down payment to leverage that to make the repairs, and you kind of use it like a credit card account, a home equity line. You repay what you borrowed. The renovation loans, you're going to at some point you have to refinance. When the project is complete, we have to refinance this mortgage, so it's sellable on the secondary market. And so what you incur there are costs for the refinance. So depending on the size of the project, there's several options that we can talk about. It just depends, I guess, the cost of the improvements.
Okay, that's good. You just gave a lot of information. So I just want to go back. So first off, you say like maybe the best way to do it is putting less down. So higher LTV and LTV for all of us that don't know what that means.
Loan to value.
Okay.
Loan to value.
Yeah, loan to value. So $500,000 house. Instead of putting 10% down, maybe put 5% down, right?
25 versus 50, right? And that 25,000 in most cases will probably cover the cosmetic improvements. If you're looking for carpet, paint, some flooring in the property, that'll cover the bulk of that. So I always recommend that as the first suggestion when we need to do some immediate improvements, but they're cosmetic. If there's structural issues or we're adding an addition or we're taking the top off the property, then we're going the renovation route.
Got it. Okay. And then the other route, this one makes sense. This is a no-brainer, the one you just mentioned, but there are other people that are trying to do more of a substantial renovation. So interesting enough, you can say you're buying the house, 5, 10, 20, whatever it is, right? % down. But then are you already preparing that home equity a part of this package? Or is it like after they close, then we just go ahead and start that home equity potential to see how much equity we can get out of it based on the appraised value of the home?
We would use the initial appraisal. So if they put 10% down, let's say using that 500K sales price of 50,000, they can then tap into that $50,000 with the home equity line. That's the cheapest route for any home buyer because home equity line fees are less than $500. You know, where if you do a renovation that may incur 100 or 200K, you're going to pay more in fees to refinance and to get that loan because it's not very common, number one, to find any company or lender that's going to do construction lending. So there's risk involved, especially when it's a major project, because the collateral, if we don't have a working relationship with that builder or general contractor, there's a lot of risk for us as a lender. So we do require in those situations where you're doing a big renovation, we do require a minimum of 10% down. We want some skin in the game so that way we know that everyone has a mutual interest in this transaction and getting it to the closing table. Going back to the cosmetic improvements, I think the home equity line is the perfect solution. Because you're not refinancing, you get that great rate on the first mortgage, you purchase the house, and then you're taking out a second, which is a very small mortgage. You know, it could be 50 or 100,000, and you're not even required to use the entire draw amount. You could be approved up for the full 100, but you can only need 20, 25 of the home equity line. And it's there and open for 10 years. So you're able to use that equity line for 10 years and take cash out for future improvements, whatever you choose to spend it on in the future.
And that interest rate is typically not locked. It fluctuates.
It's variable good question with prime. It's an indice set by the Federal Reserve. So the rate is variable. It could change monthly. the interest rate, the average rate for a home equity line at 100% LTV, so 100% loan to value, is anywhere between 5 and 6%. And that's going to be less than a project loan through Home Depot or Lowe's or a credit card cash advance or credit card charges. It's going to be a lower interest rate, and it's also amortized over 30 years. So you're going to have a lower. Yeah.
Yeah, that's great to know. That's really good to know. Okay, so so a scenario. Let's say you have a VA buyer. It's the second time he put 5% down.
Okay.
So he could use it his second time without lower VA funding fee.
Funding fee.
Right. And would he or she be able to use something like that after closing?
VA, I'm a expert on VA financing. I know everything there is to know about VA. Most of our clients are veterans, and so VA actually offers an EEM mortgage, energy efficient mortgage, where you can finance energy efficient repairs. So that can be done at acquisition. It's just tacked onto your loan. And energy efficient repairs consist of like new HVAC, hot water heater, new windows, new doors, things that are going to cut your monthly utility costs. There is an approval process involved, but it's very simple. This actually goes with your scenario where a property may have been sitting on the market for a while. That seller is probably inclined to accept the VA offer, where a property with more competition may have a stigma against VA and not accept it. This allows the veteran who it may be financing 100%, allows them to finance some of the big mechanics of the property that may be out of date, like the HVAC system. That's probably the most common ticket that we see. What we have to identify is that the cost or the increase in the monthly mortgage obligation is less than what the utility cost decrease is. So the savings on the utility cost must be greater than the monthly payment increase. And it's 10 out of 10 times it always is.
Wow, that's great to know about. So the energy efficient EEM, say that one more time?
Correct. Yep. EEM. Yes.
Okay. And that is something that can be done. Is it a different underwriting, anything at all, or is it something that just a conversation?
There is an extra step. There's a letter required from the contractor to verify like the utility cost savings. They actually give us a breakdown itemizing what it is currently and what the projected utility cost will be. We have contractors that we've worked with before that are familiar with VA and are on the approved list. So it's a very simple. The extra step is really a letter from the contractor. And the cost for the repairs is funded at closing, paid to the contractor.
Got it. Okay, that's really good to know. And I was going to ask you one more thing about that. Typically, what do you see as the percentage or the cost that you're seeing? I mean, on most of these closings, it's like 5% over the sales price
for the VA.
Yeah.
For the VA, no, it's less than that. I would say 1 to 2% of the sales price is what we see financed, because there's a limit on what VA will finance. Generally, it's just we'll do an HVAC system or some windows or doors. They have a cap on what they will allow based on the acquisition price. And I believe the cap is 2%. We never see it go above the 2%.
That's good to know. That's great.
And I'll verify that, Tim, and send you a note on it. I believe it's 2%.
That's very helpful, especially in this environment where our team has nicknamed homes that have been on the market for more than 2 weeks. We call them the second chance.
Yeah.
And so we talk to our buyers that are saying, well, I just can't find anything. I was like, well, have you scrolled down to look at the homes that might be a second chance? Because they're just there and people are not pulling the trigger on them. And why not? And if we know that we have opportunities within our loan to make these small improvements and be smart about it, and that you're still buying the house you like, just making the right improvements, and it makes sense that it's still a value in the neighborhood, then you should consider these second chance homes, right? So
we have a solution. I'm sorry, Joe.
No, I'm just saying it's definitely possible with these options. That you can't forget about this stuff. A lot of lenders don't offer it, and it gets swept under the rug. So
yeah,
I agree. Yeah. We have a solution too for sellers too, like where we have bridge financing, where if they don't have the capacity to make these improvements, which makes their home a second chance home, we have bridge financing that will allow them to make those improvements and also be used for the down payment of the next property. So that's something that we can help with too with your sellers. We do obviously want to represent them in financing as far as the new purchase that they're looking for, but we can help with the improvements as well. I believe Compass has something. You guys have something like that too as well, right?
We do. We have that, and we also have like a Compass concierge service where you can just, based on how much value you have in the house equity, you can actually get the loan to do the refresh and then pay it at closing. But
wow,
the bridge loan is also a great opportunity. It sounds complicated. So since you opened up the can of worms on it, why don't you tell us about it?
Bridge allows, like most home buyers, they that currently own a home, they need to sell their property to buy the next property. The bridge allows them to easy explanation, allows them to tap into that equity to be used for the down payment on the new property. It's probably it's saved hundreds of our clients, because in today's market, home sale contingency just doesn't really fly, unfortunately. This option allows you to avoid having that home sale contingency, depending on qualifications, obviously. But we do actually have two bridge products. We have a traditional bridge, which is where you're tapping into the equity, using it for the down payment to purchase this new property. And then once your home sells, that bridge loan is paid off. It's paid off at settlement. Very small monthly payment. The payments are interest only, sort of like the home equity line of credit. An alternative option for someone that doesn't qualify for the financially, maybe they can't carry two mortgages, which is not uncommon. We have a bridge acquisition product that will allow the borrower or the seller to purchase this new property at 100% financing. However, it must be refinanced when their property sells. So it's a solution to, in this very fast-paced market, competitive market, to make an offer non-contingent. And we, on average, closed a bridge acquisition loan in 10 days. So that also gives your buyer leverage when you're competing against maybe cash or other very strong qualified buyers. It's been a very, very helpful tool for us to be successful. And we released it about 2 years ago. And it's funded by First Savings. We underwrite, we do everything internally.
All right. So that was all the that was all the academic lingo. I totally get it. But let's run a scenario. Let's say we got a seller, owns a house. It's worth $700,000. He's ready to move up, wants to buy $1 million house. But all of his got great income. So all that part's fine. Let's just say he calls us up and says, man, I gotta get out of this small thing. I need to move up. And so he's lived in the house for 20 years, right? So what can we do? Tell me how that rolls.
First, we go over the qualifications, and let's assume this buyer is well qualified. We would verify the existing mortgage balance on the property, and the max that we'll lend for the bridge. This is a traditional bridge where you're using the equity for the down payment. Our borrower's qualified; he can qualify carrying the obligations. We'll go up to 90% of the estimated property value, and we'll use your knowledge as the agent to give us a CMA to determine what that property value is. And so combined loans, the existing payoff, and the bridge cannot exceed 90% of the current market value of the property. That would then be applied, that amount would be applied for the down payment of the new property.
So let's just say that all the numbers work. So you're talking about $630,000 and let's say that value of that house is $700,000 on the market. So we're now talking about $630,000 is available.
Correct. Less the existing mortgage balance. So if there's a 500K lien, then we have 130 that can be applied towards the down payment of the new property, which would work in the situation you mentioned, $1 million acquisition for the new property. He could put 10%, he or she could put 10% down on the new property without selling their home first.
So he looks just like a regular conventional buyer.
Right, actually, and then in addition to that remaining 10% in the property, a lot of buyers don't know this, or sellers don't know this either, but after purchasing a new property and selling their existing property, they still have that 10% equity in the property. They can apply that towards the principal balance of this new mortgage and recast. They can request a recast of the mortgage, which resets the amortization schedule, gives them that lower payment. And that's actually what holds a lot of sellers up from selling, or closing simultaneously. They prefer that because they want that obligation to be as low as possible. And the recast has become, it's something, a very old term that's become very, very popular over the last 2 years.
Got it. So, I mean, essentially we're dealing with two closings. So there's gotta be some drawbacks. I mean, we heard all the advantages. So what's the drawback? And I mean, is it costly for having to do two closings? I mean, are we doing a whole new title insurance policy? Are we doing?
Good question. Traditional bridge, no, we don't require appraisal title. The cost on average are around 3% of the loan amount for the traditional bridge. And those fees are mostly recording taxes and mostly related to the attorney in county and state.
Got it. Okay. Well, that's not so bad if it's something that makes sense in this very competitive market to be able to get the house you want without having to sell first or home sale contingency, whatever it may be, post settlement, find a house, 60 days kind of thing. So, okay. What is the timeline like with you guys when you guys do a consultation about this? I mean, how long does it usually take to work with the realtor, work with the seller, that's going to be a buyer? What does that look like usually on time period?
For like the initial qualifying, I mean, I can qualify someone in 30 minutes on the phone, and then we'll direct them to the application, and we'll actually issue formal pre-approval from there. The initial vetting is pretty simple. We talk about income, we talk about credit and assets as well. Once we made it past that step, we'll go on to an actual electronic application that's completed online. Joey and I can usually turn that around in 24 hours, if not the same day, to issue pre-approval, and then your buyer's out looking for their new property.
Wow. That sounds like a really good plan for many sellers in this environment that are ready to get the itch. I mean, after the holidays, you always see how your house really lives in it, you know? I don't know about you. This is the time we always say we're dreaming, right? Everyone's starting to dream a little bit, get a little extra time in the day to think about things. And what would you do different? I always ask that to our clients after a few years, like, how would you buy differently? And then they go, well, I'm happy with what I bought, but I think I would have maybe got that extra room, or maybe finished out that basement or something. But these are great opportunities for people thinking about doing something. And still, when you think there's no hope, there's actually opportunities to use these programs to actually still make it happen in a competitive market like we got right now. It doesn't seem like it's ending.
Yeah. Going with what you said there's a lot of people who are my age, 20, late 20s, early 30s, who, think, oh, I can't do that. I can't afford that. There's no way that's possible. I only make X amount of, and the simple fact is there's so many options out there for them. And we can help them explore that, and I would never say, don't smash your dreams. I mean, come to us. Let me put a pre-approval together for you. Let me look at your income. Let me look at your information. And then we'll try and set you up with a, solution that fits for you. So, don't ever say never because we can qualify a lot of people. So.
Yeah, that's right, Joey. I mean, I think you hit the nail on the head. It's once you have knowledge, then you are empowered to actually do something with it, make a decision now or maybe later, but you've got to know what the opportunities you have. And if you don't, you're just kind of just spinning your wheels. Well, I guess I can't buy the house. Look, it's $800,000 went pending. That guy may put a 5% down on it, right?
And you never know.
You
never know.
Even 3% now with today's loan limit increases. Yeah.
Yeah. Amazing. It's great. I think it's like you guys said. I think it's there's green lights. You just got to look and say, wow, this is an amazing opportunity. I mean, I don't know about you guys, but I keep pinching myself thinking that interest rates are this low. I mean, I talked to my folks and they're like, man, I bought my rate down and it was 11.5 to like 11 and a quarter or something like that. And like,
right.
Or 18%, we're able to buy $1 million asset with low interest rate environment. If you've kept your credit good and you've done all your things right for the last 5 years, whatever, you're set. You can really, this is a great way to live in a house that's going to create a lot of your wealth in your part of your portfolio in retirement. So I think it's just a great opportunity to do this. It's just a matter of knowing what is the right tools for you to exercise.
Mm-hmm. It's one of the best investments you can make in yourself, and I think everyone should do it, and they'd be extremely surprised to see what they could actually qualify for. I ran into a lot of people who were like, oh, really? That they didn't even think they could come close to what they could qualify for, but I think it's always worth a shot to see what you can get.
So do you guys usually talk to a potential buyer like a consultation first, or do you have them fill an application first and then schedule a consult over what you get out of it?
All of the above, text, call, email. Yeah, it's always great to have that initial conversation with them, even if it's 15, 20 minutes, because the application is boilerplate. It's the same application completed by every borrower. We don't have notes, and it's good to take down those initial notes up front, not only for our purposes, but for going forward for you as the real estate agent, but also our underwriting department as well. A quick call goes a very long way. And that's something that we try to do with every client before and after the pre-approval session.
That's great.
Yeah.
Okay. Well, Jerome and Joey, it's a pleasure having you guys on here. I wrote down a lot of notes, and my head is just like full of tons of knowledge. And I'm sure we're going to extract that over the next few weeks. But I can't wait to even actually just call a few clients today and just say, did you know? Have you thought about? Did you consider? It's just thinking a little bit more outside the box. And it's really doesn't sound like it's outside the box for you guys. This is mainstream lending, right? Financing.
It totally 100%. We definitely make sure we look at all options for every client. And we have a good team, good support staff here, a great team support staff, and our secondary department who controls guidelines. I mean, they're constantly giving us overload as far as information, and we continue to educate ourselves and our clients every day. I learn something new every day. I look for those new programs. I try to place clients in those new programs. We push the limits as far as like capacity and knowledge.
Yeah, that's wonderful. Well, thank you so much, guys, for spending your precious morning here for 45 minutes with me. This is great for all of our clients and also ones that are thinking about doing something in 2022. And you guys just brought the A game, man. Tell us what we should be expecting. So thank you so much for that.
Yeah, we're always here for you.
Yeah, right. Our pleasure completely. Thank you for taking the time with us as well today, Tim. I really appreciate it.
Yeah, take care. All right, I'm gonna put it on record. Stop record real quick.
No problem.